Hello and welcome to our latest Autovista group video, which we have produced together with Sam Livingstone from Car Design Research. I'm Autovista Group Chief Economist, Christof Engelskirchen, and this is part one of the video where we talk about how investors value the car-producing tech companies so much higher than the traditional car manufacturers. And the big question is, what are those traditional car manufacturers doing to address this, and what should they be doing? And Sam, it is so wonderful to have you in this discussion with me today. Hello, Sam.
Hey, Christof, good to be here with you too. Yeah, I think it's a fascinating topic, isn't it? You and I were speaking only a week or so ago, and I said to you, why is it, or how can it be that companies like NIO, for example, can be worth more than such, large, established, famous car brands like Ford? I mean, I'm not an investor. You are perhaps a little bit closer to an understanding of that space, but I was curious to sort of, how can it be that these such small fledgling companies, which inherently must be fragile, how can it, and also which are fundamentally not, if you like, selling and reaching the same audience at this stage, how is it that they can be worth so much more? Is it legitimate, I suppose, is the core thing in my head. I mean, I suppose it must be, but how can that be?
Yeah, and it's something which I think a lot of people have looked into, for all kinds of reasons. And I did as well, and I looked up a couple of valuations. And for example, the shares of Tesla, they rose by almost 800% in 2020. Apple, for example, from obviously more entertainment industry rather than car tech industry yet, they rose by 80%. And the traditional car manufacturers, they stayed stable in their share prices, in their market capitalization over the entire last year, which isn't bad, yeah, but it's clearly far less engagement and enthusiasm than with some of the tech companies. And I mean, the technical answer to the question that you asked, why is it legitimate? It clearly isn't based on the current performance of these companies. For example, Apple's profits have been declining for the past 5 years. Tesla is barely profitable, and they are selling 1/20 the number of cars than, for example, Toyota. Yeah, so 500,000 cars sold by Tesla, and 500,000 cars by Tesla and 10 million by Toyota. Yeah. So is it legitimate? The thing is, investors put a lot of trust, enthusiasm in the growth perspective and potential that these companies have, and that is, they see that there is more potential than with the traditional car manufacturers currently.
Yeah, and so you've got this. So there's apparently some legitimacy to this sort of perception that the value that they have got is on what their potential is relative to where they are now. But the disparity you've got with these, if you like, startup or tech-centric brands relative to the incumbent OEM brands, it feels like there's some discordance there. By which I mean, we've got lots of clients on the OEM side, and I think there must be some inherent frustration from them, which is to say they look at these new startups, which are very formative and sometimes, if you like, quite naive, it seems, in what they may offer, or fragile in where they may be set to go, and yet they're fundamentally they have more money to play with, and there's a bit of me that wonders, is this a bubble? Is it going to burst? Is there a level of naivety on the part of the sort of a wider investment body, which is to say these new ambitious ideas must stick, that the incumbent car brands may not be able to deliver that? What is, if you like, the lack of faith in the ability for the OEMs to be able to transition to more connected, more autonomous, more shared, more electrified vehicle proposition to be more successful? I don't know. It just seems like there's this sort of unbalanced situation. On the one hand, it's like, are they not valuing sufficiently the incumbent brands who fundamentally have a lot of competency, but are they too conservative? And yet maybe on the other hand, they're valuing so highly these as yet unproven, potentially fragile organizations.
Yeah, so I mean, first of all, the question whether there is a bubble or whether some of the valuations are not legitimate. Honestly, there's always talks about these things when things go through the roof, and clearly when you look at the more traditional ways of evaluating performance of a company, there seems to be a disconnect with what the companies have proven that they can do versus what shareholders, investors hope that they will be able to do. At the moment, there is really no alternative to putting your money elsewhere. So for a lot of investors, it's a bet. Money is cheap. It's a question of diversifying your investment. And what those say, that some say it's not a bubble, it's legitimate, and those people argue that these companies have been so potent in terms of creating technology, in terms of innovation, that it's far above, for example, the performance and the capabilities that we saw when the last internet bubble burst. Yeah, so there's really again no real comparison to the past, and that's why you have some people who are really confident. Some say, yeah, maybe it's a bit overpriced. But the other important piece here is that investors are not, they're not punishing the traditional car manufacturers. I mean, last year was tough. So we had, massive declines. Margins are down. Revenue was down. Profit was down. But still, the market capitalization of the likes of Ford, Volkswagen, Toyota stayed stable. Yeah, over the entire year, maybe rising a bit. I think GM was actually having a bit of a better share price performance than some of the peers in the traditional OEM sector, right? So it's not that investors are not giving credit to what they are doing, what they're capable of, and there is, I think, there are a couple of challenges that tech companies are just not faced with, right? So I called this clutter before, but maybe it's not the right word. It's just that the OEMs, before they can really thrive, they need to get sorted on a lot of areas. So they need to transition from internal combustion engine to electric vehicle technology. So that's number one. That's the most crucial, most important, most short-term disruptive trend, which is definitely here and needs to be lived through. The other thing, which has been quoted a lot, is that they need to transition to a more software-led product development process. And this is a challenge for them because they are not coming from that tradition. Yeah, they don't have that capabilities. They have no proven capabilities of delivering, software that is fantastic, and the rest falls in place. And this is where tech companies have been really good at. And so this is an area where they need to become more professional. And then, maybe the last challenge, which is maybe a bit unfair, a bit different, is that the tech companies, they have access to a lot of funds. They can raise cash extremely easily at this point in time, and they can invest more money into those other 4 megatrends. So we have electric vehicle as one megatrend, but we have autonomous, connected, digitization of sales and after sales, and shared mobility. So they have more money, more funds available. And when I was thinking about a picture of how I would describe an OEM, traditional OEM versus tech company, it's like a cruise ship, yeah, which is running at full speed, very powerful, pretty fast, but it's just a bit more difficult to steer it in the right direction, to have the cultural change going in the right direction. But also maybe a question to you. You are working with both types of clients. Does this resonate? What I'm saying, do you see this in some of the interactions that you're having with your clients?
Yeah, no, it does for sure. And I mean, I suppose also underpinning a lot of these sort of hard engineering ingredient elements that you've alluded to, there's also, if you like, cultural aspects too. There's something in here about belief, ethos, and actually, I suppose also slightly less soft, but it's actually fundamentally organizational infrastructure, competency, people, personnel, and there's quite a different shape, which is, you know, it fits the cliches to some degree, the profiles of the OEM client versus the profiles of the startups. And also, I guess this goes back to our original thing of the investor, you know, the nature and behavior, you know, even the sound of the brands and so forth. There is something much more 21st century about these startups, which I think chimes particularly with the individual investor. But your cruise ship analogy, I think, is great. I'm not sure if you articulated if the OEM is the cruise ship, exactly what the startup is. You know, is it the hydrofoil or is it the airplane? But in terms of getting to the other side, reaching your destination, okay, so maybe the cruise ship is slower and harder to steer, but it has a certain reliability to it, doesn't it? Or a certain confidence in, you know, one can rest on a cruise ship and be more calm than you might be able to in another vehicle format. I shouldn't stretch your analogy too far. But we've also touched on how some of the incumbent OEMs are sort of adopting some of the ways in which the startups are doing. They are pushing electrification forwards harder. We've got the if you like, the commitment from GM, I think, just this week. We're also seeing how Ford aligned with Google, or made announcements with Google, I think, this week as well. So there's all sorts of ways that the incumbent brands are, if you like, reaching into some of the spaces that you know you've talked about. And I'm sort of thinking, well, if they do this a bit more, one presumes they can close the gap on their share value. You know, maybe they can get to be more cash rich. Maybe there's other things they will shed or address, this sort of infrastructure, the slowness, the size of the ship, to use your analogy again, such that they can be more like that. But there's a bit of me that also wonders, and maybe this is a question back to you, it's like, well, surely these car companies, many of which have been around for decades, if not even 100 years, it's not just a negative, that legacy. There's a vast amount of competency, understanding this amazing, sophisticated consumer durable, and the manufacture of it and the distribution of it, and therefore and related. Is there not ways in which they should be leveraging their inherent competencies that these other startup guys fundamentally don't really have? I mean, I worry sometimes with my clients that they are very much turned to this exciting new thing that everybody's talking about and seeking to emulate them, and as well they might. But is there not some stuff that they have that they should be, if you like, building on their amazing competences to ensure they're differentiated and not just sort of trying to emulate the behavior of the startups? I don't know.
Exactly. I mean, if we look maybe at, I mean, if we move a step back, and if we look at society, if we look at the role of competition, in our understanding of you know, of how markets operate, competition is a blessing. Yeah, it's moving things around. It's creating change, and afterwards usually there is more value, yeah, to be shared. Sometimes the value is distributed unfairly to maybe a few people, but it's creating more value. Innovation, competition is creating more value for the consumer, for society. Usually, right? This is where we're all coming from. This is the world. This is part of the world, yeah, we're living in. Innovation, competition, free trade. So what I do see, and you're quoting some of the activities from traditional car manufacturers, and it sounds so, you know, it sounds so backward looking, right? Calling them traditional car manufacturers. I mean, they're trying to get away from that, and by leveraging the success that tech companies have, and basically trying to emulate this or trying to find creative ways to work differently, I think they are taking or getting benefits from you know, that amazing performance on the stock markets that these companies have, and also amazing innovations that these companies produce. So I think that's good, right? It creates change. It helps the traditional car manufacturers to change their organization, to change their culture.
Sure.
There is, as you mentioned, you know, at some point they need to think about what they're good at and what can be conserved, and what can be leveraged into the future. And that is certainly topics like production efficiency. Yeah, it's to some extent supply chain experience for producing complex things. I mean, a little bit of a side argument is that we're trying to take complexity out of the product, right? So the argument that we are super good in creating complex products is not the best one, but there is some supply chain manufacturing competency which will still be required. So cruise ship operations are different to catamaran operations. Yeah, and that has to be to some extent has to be an advantage. And I mean, for example, if a manufacturer can produce and distribute 10 million vehicles in a year, that must be an advantage also for tech companies that may not be there yet. They may not be in a position to deliver 10 million cars into the world because they don't have the network, they don't have the supply chain. So that's an advantage, and I think that and this is maybe also a softer topic where you can also maybe comment a bit your view is around the brand and the history and the emotion that is associated to the brand, and that took many years to build up and is quite resilient and cannot be replicated that quickly.
Yeah, no, totally. I mean, I think that's a big thing, and I'm sure that both on the tech side, tech clients, or the new startup car producers and the existing ones are well aware of that. I think the legacy brand is hugely important. And whilst there's going to be on one hand a body of customers for whom driving something with an Apple brand or a Samsung brand on it might have a real wow to it. In terms of investing, potentially 50,000 euros or in some way committing financially quite significantly to a product, having confidence in its ability to still work the next day, the next month, the next year, 10 years time to be of value downstream. I think that the existing car companies are going to have that strength for some time, but that's quite prosaic as well. Those qualities are quite prosaic, just as to some extent, whilst they're important, your comments about supply chain, managing the ability to deliver and distribute this incredibly complex product is massively important, but they're sort of prosaic ingredients. They're relatively functional. I think there's this whole emotive thing, and if you like, the aspirational things, the things that attach to words like premium and luxury, which many car brands have now, which I think even brands like Tesla struggle with. And you bring in a Sony or an Apple or another brand like that, it has equity, it, if you like, has some credence and trust and premium association and positivity in its meaning. But then you look at how long it took Audi to become established as a premium brand in Germany, in Europe, in the world. It was a lot of effort, and I'm going to throw 2 decades at you and suggest it was about that long. But broadly, it was not the work of moments to go from being a, if you like, normal car brand to one which people aspire to own, and it is a sort of properly recognized premium position. And okay, so you can't just apply those old 20th century rules to the 21st century per se. But whilst the car is this sophisticated technical artifact, it's fundamentally a thing that people have relationships with and that projects identity and meaning, and that actually has to, if you like, weave its way into people's lives in all sorts of soft touch point areas. So if you can just be confident that it will work and that it's technically accomplished and it's electric and whatever, I'm not necessarily sure how the startup brands have got an advantage in terms of how they connect to people and in terms of how the market actually might wish to have them and how they have associated levels of prestige and so forth. And I think that, I don't know, I think that's an area of it's an area that the car brands, in my view, should perhaps hold on to more, have more clear sight of, the potential to ensure and protect the hard-earned equity of their brands in terms of how they signify meaning to their customers and how that meaning itself is attached to potentially premium price, but also a fundamentally more robust and more valued relationship. Because, yeah, I mean, at the moment, of course, the other sort of lens to look at this is that the people who are perhaps investing in, and it is still mostly Tesla, but the Neos are coming through and the other brands, I put it to you that those are people are broadly wealthy, but also people who are at the very least early adopters, if not true innovators. And so they are not going to have. They're going to be they're going to move from brand to brand in all sorts of sectors. They're going to be less concerned with longevity and other sort of external measures of status that are attached to brands. But for the core market, for the majority of the market, I don't think that's the case. So you could argue that as a lot of these new startups reach in towards the mainstream, they're going to hit buffers, which is inherently a body of customers who behave like normal people, and who don't just want to have the newest, latest thing, and who do not just trust everything that's box fresh. I
mean, Sam, I think this is a perfect time to stop this part 1 of our video, because what you mentioned, what we talked about, is a lot about what needs to change, and you've pointed out that there may be more need to also talk about things that need to be preserved, right? And this is a big challenge to to instill change while at the same time holding on to things that you do not want to change, that you want to build up. So if this is the end of part 1 of our video, and thank you, Sam, again for joining us. You all might be interested to tune into part 2 of our conversation, again with Sam Livingstone, where we talk about something more operational, but still very techy and and quite challenging and actually quite fun. I think it's a fun topic. And this is how touchscreens will redefine the way we see and operate cars. And also again, I'm using traditional OEMs in this context. They are also making quite some inroads into this touchscreen universe. And it'll be part 2 of our conversation. But in the meantime, don't forget to subscribe to our podcasts on Apple, Spotify, Google, and Amazon Music. And then also go check out our YouTube page with all the latest videos. And if you haven't done so, please sign up to our Autovista Group daily brief email at autovistagroup.com/sign up.